Good evening and welcome to Kenya News Update today. I'm your host, and tonight we're taking a deep dive into a story that's resonating far beyond its borders, sending ripples through global markets and offering a crucial lesson in economic policy. The topic, China's recent Lunar New Year holiday spending, and the surprisingly strong signal it's sending about the future of consumer stimulus plans worldwide. For the next 12 minutes, we'll unpack what this means for China's domestic economy, its global trade partners, and the delicate balance policymakers everywhere are trying to strike between stimulus and sustainable growth. We'll examine the raw numbers, hear contrasting expert opinions, and place this moment within the broader context of China's ambitious industrial transformation. This is more than just a retail report. It's a window into the economic soul of the world's second largest economy. Let's begin. Our story starts with the conclusion of the 9-day Lunar New Year holiday, which ended on Monday, February 24th. This period, known as the Spring Festival, is the most important traditional holiday in China, a time for family reunions, travel, and, crucially, consumption. For economists and investors watching Beijing, it serves as the first major real-time health check on Chinese consumer sentiment for the year. And this year, the initial diagnosis is cautiously optimistic. Preliminary data released by China's Ministry of Commerce and various payment platforms shows a steady, if not explosive, rebound in spending across multiple sectors. From hotel bookings in popular tourist destinations like Sanya and Harbin to duty-free shopping in Hainan, and from box office revenues for domestic films to restaurant reservations in major cities, the trend was uniformly upward. This recovery, analysts say, is just robust enough to potentially convince China's top policymakers that they can hold off on deploying the kind of large-scale, broad-based consumer stimulus packages that international investors and some domestic commentators have been clamoring for. Instead, the focus appears to be shifting toward more targeted, sector-specific support, particularly for the high-tech and advanced manufacturing industries that China sees as its future. Let's look at the numbers that are driving this conversation. During the holiday period, domestic tourism trips reached 632 million, a year-on-year increase of 7.3%. More importantly, tourism revenue hit $79.3 billion, surging by 30.8% compared to the same period last year. That's a significant jump in per capita spending. Box office revenue for the 8-day holiday period shattered records, exceeding $1.5 billion. Now, here's a critical comparative figure. While spending was up sharply from last year, it was only about 0.2% higher than the pre-pandemic levels of 2019, when adjusted for inflation. This nuance is at the heart of the current debate. On one hand, the 30.8% surge in tourism revenue is undeniably strong. On the other, that mere 0.2% growth over a 5-year benchmark suggests the recovery is still fragile and incomplete. This is the tightrope Chinese authorities are walking. The question they must answer is, does this data show a consumer base resilient enough to power growth on its own, or does it reveal underlying weaknesses that still require a significant fiscal boost? To understand the policy implications, we need to bring in our first perspective. We're joined tonight by Dr. Li Wei, an economist at Peking University's National School of Development, speaking to us from Beijing. Dr. Li, thank you for your time. The holiday numbers are in. In your view, do they signal a fundamental turnaround in consumer confidence that justifies a more restrained stimulus approach? Thank you for having me. I believe they do, but with important qualifications. The key takeaway is not the absolute level of spending, but the direction and composition. We are seeing a clear shift from goods consumption to experience and service consumption, travel, entertainment, dining. This is a hallmark of a maturing, post-industrial economy. The 30.8% growth in tourism revenue is particularly telling. It indicates that when Chinese consumers feel secure, they are willing to spend on high-quality experiences. Furthermore, payment data shows a notable increase in spending from lower-tier cities and rural areas, suggesting the benefits of past rural revitalization policies are filtering through. This organic, broad-based recovery in services is precisely what policymakers have been hoping to engineer. Pouring massive, untargeted stimulus into the economy now could overheat these specific sectors while doing little to address deeper structural issues like the property market correction. The prudent path is to continue with targeted fiscal support for household incomes in specific regions and for strategic industries, while allowing this consumer-led recovery to find its own footing. A compelling argument for patience and precision. Now, let's hear a counterpoint. We also have with us Marcus Chen, a Hong Kong-based strategist for a major international investment bank. Marcus, you've been vocal in your calls for more aggressive stimulus. Do the holiday figures change your calculus? Not substantially. While the headline numbers look good, we must look beneath the surface. That 0.2% real growth over 2019 is the statistic that keeps me up at night. It means that after 5 years, including a global pandemic, Chinese consumer spending in real terms is essentially stagnant. This is against a backdrop of deflationary pressures in the producer price index and continued stress in the property sector, which historically accounted for a huge portion of household wealth. The spending we saw was largely on services and experiences, which are less capital intensive and have a smaller multiplier effect on the broader industrial economy than durable goods purchases. What we need is a confidence shock, a significant direct transfer to households or major tax cuts to boost disposable income and reignite demand for big-ticket items. Without it, this service sector recovery may prove to be a flash in the pan. Investors are pricing in disappointment. The market rallies on rumors of stimulus and sells off on the reality of incremental measures. The government has the fiscal capacity. It should use it decisively. So we have a clear divide. One side sees organic recovery, requiring careful nurturing. The other sees fragile demand requiring a decisive jolt. This policy debate is happening against the backdrop of another, perhaps more transformative, economic story in China. While consumer spending recovers at a moderate pace, the country is charging full speed ahead in building its industrial future. According to official data, in the year 2025, China registered a staggering 1.13 million new companies in what it terms emerging and future industries. This represents a year-on-year increase of 9%. These sectors include artificial intelligence, aerospace, biomanufacturing, and new energy. The government is funneling vast resources into these areas through low-interest loans, tax breaks, and state-guided investment funds. This leads us to a critical question. Is China deliberately choosing to stimulate production and technological supremacy over direct consumer demand? Is this the new Chinese economic model? A consumer base that is stable enough, paired with a state-driven industrial engine that is relentlessly ambitious. This strategic pivot is evident in the latest GDP growth targets. While the overall target for 2026 is expected to be around 5%, growth in these high-tech industrial sectors is consistently in the high single digits. The government's dual circulation strategy explicitly aims to reduce reliance on foreign technology and consumer markets by building self-sufficiency or internal circulation in critical sectors. The consumer, in this model, plays a supporting role, providing a stable domestic market for these new industries, but not necessarily being the primary driver of growth through debt-fueled spending sprees. This represents a significant departure from the Western, particularly American, model of growth which is often disproportionately driven by consumer spending. China appears to be betting that long-term power and security come from controlling the industries of the future, not from having the highest per capita retail sales today. The global implications of this choice are profound. For commodity exporting nations, including many in Africa, a China focused on advanced manufacturing may mean sustained demand for industrial metals and minerals, but potentially less demand for lower-value consumer goods. For Kenya, which has sought to increase exports of agricultural products like avocados and tea to China, the evolving consumption patterns are crucial to watch. A service-oriented Chinese consumer might spend more on travel and entertainment, but does that translate to higher demand for imported foodstuffs? Furthermore, China's success in fields like electric vehicles and renewables directly competes with the industrial ambitions of other nations, including those in the West. This industrial policy is not happening in a vacuum. It's a statement of intent on the global stage. Let's visualize this two-track economy. On one track, we have the recovering consumer sector, and on the other, the booming future industries. This divergence creates both opportunities and challenges. For the Chinese workforce, it means high-paying jobs in tech hubs like Shenzhen and Hefei, but potentially fewer opportunities in traditional manufacturing. For the rest of the world, it means dealing with a competitor that is simultaneously a massive market and an increasingly sophisticated rival. The upcoming World Athletics Council elections in Beijing in 2027, set just before the World Athletics Championships, symbolize this dual role. China is not just hosting a global sporting event, It is seeking leadership positions within the international governing body itself, reflecting its desire to shape the rules and narratives in every arena, from sports to trade to technology. Returning to the consumer, a key metric to watch is youth unemployment. Recent initiatives have promoted what's being called the low-altitude economy, commercial drone operations, aerial tourism, and short-haul air transport, as a way to create new, tech-adjacent jobs for graduates. Early reports suggest hundreds of thousands of new company registrations in this niche alone. If such sectors can absorb talent and generate disposable income, they could provide a more sustainable boost to consumer confidence than any one-time stimulus check. The ultimate success of China's economic rebalancing may hinge on whether its futuristic industries can create a prosperous, confident middle class that spends not out of holiday tradition, but out of sustained economic security. In conclusion, the message from China's Lunar New Year spending is nuanced. It is a signal of resilience, not exuberance. It suggests a consumer who is cautiously stepping back into the marketplace, favoring experiences over extravagance. For policymakers in Beijing, this has likely tipped the scales toward a policy of restraint, favoring surgical support for strategic industries over blanket stimulus for consumers. This choice defines the next phase of China's development and its relationship with the global economy. It is a bet on national industrial power over immediate consumer-driven growth. Whether this bet pays off and what the consequences will be for global trade patterns, supply chains, and geopolitical alignments is the defining economic story of our decade. For Kenya and the world, understanding this shift is not optional. It is essential for navigating the economic landscape of the 2026 and beyond. From all of us here at Kenya News Update Today, thank you for watching. Subscribe to Kenya News Update Today for more in-depth analysis.